All right, gentlemen, let's break down this article that was written almost 4 years ago. It's titled Problems with Infinite Banking and Bank on Yourself Concepts. If you're riding down the road, you may want to go back and watch the YouTube. I'm going to scroll and give us just some of the input as we go through. And it's 7 different reasons why this is a scam or it's not a good idea. And I think there's probably a handful of points in here, gentlemen, that we could break down and help people maybe get their arms around maybe some misconceptions, right? I'm not going to call all of it completely false. I think some of it's just misconceptions. But first, the one I noticed at the beginning says, frankly, all of these terms referring to becoming your own banker, infinite banking, bank on yourself, these terms are scams. I hate the word scam. I just got to tell you, to me, this is one of those things that probably gets under my skin the most. Is when I think of the word scam, Joey, I think of, the Nigerian prince trying to get my grandmother to give her her login to her, bank account so he can put back in the money he accidentally took out when he was charging her for her, Norton antivirus, right? When I think of scam, I think 100% criminal enterprise. Are you with me on that?
I'm with you 100%.
So when I see scam, that's why my brain goes to. And I've been in the financial industry for 20 years. I've been doing infinite banking for 15 years. I have met hundreds, if not almost thousands of people at conferences all over the U.S. and some of the best people I've ever met in the world work in this industry. Agree or disagree?
Totally agree.
And you worked in a whole different world. You were in the banking world, right? Working for a large bank. Did you have the same reaction where, did you work with the best people in the world there too?
No.
Okay. Well, I didn't know what you were going to say there. Be honest. I thought
they weren't bad. They weren't all bad, but there's some bad apples. I think the infinite banking world, those that are practitioners in this concept, are far superior in terms of their moral compass and integrity and everything else.
What's the most important resource that you have? If you really thought about this deeply, I think you'd come to the same conclusion that Joey and I did. It's time. In our newest book, Wealth Without Wall Street, The 3 Steps to Financial Freedom Through Passive Income, we talk about how are we tracking that time? What is the thing that we can do to get more of that time back?
That's right. If you've ever been listening to our podcast and thought, man, it would be amazing if I could take all the things that you guys have learned over the last 10 years and just summarize them, put them in some way to easily digest them and take action, that's what this book is all about. You're not going to want to miss it. Go to wealthwithoutwallstreet.com/new book and get your copy today.
By the way, we know that there's plenty of people who use the word infinite banking and becoming your own banker, bank on yourself, that don't know much more than you listening for the very first time, who use that term, and they do use it poorly, and they say things that are untrue. So definitely not casting a net to say everybody is good, but I will just say as a whole, I believe that to call it a scam is, I think that's just too harsh of a language, because scam means somebody's criminally trying to do something wrong. All right, Ern, point number 1, it says infinite banking requires you to buy a whole life policies. There's a lot of details in here. I'll let you kind of highlight different areas if you don't mind.
Sure. And there's a lot. Every single sentence in here is worth pausing on, but unfortunately, you've told me I don't have that much time. So let's start with the first sentence. Let's start there. That's good. Step 1 in infinite banking is to buy a whole life insurance policy. 100% agree with that. In fact, that's more clear than some of the people in our space are even with the infinite banking concept. Here's the part that I'll disagree with, though. It's not actually step 1. Buying the insurance policy would actually be the last step in incorporating this concept. Step 1 might be to evaluate in your financial situation, where are you? And look past that. Where would you like to go? What's the outcome? What's the ideal outcome? What does that look like? What does it feel like? When is that? And then finding a guide, a coach, as Nelson Nash said, even in his book, who has a good track record in practicing themselves and helping other people put together step after step after step so that you can go from where you are to where you want to be. And then knowing that information, you can buy the life insurance policy. Moving on, whole life insurance has a terrible reputation. Well, it's 2024 right now, election season. There's pockets of people who would say that Republicans have a terrible reputation. There's a pocket of people who would say Democrats have a terrible reputation. I guess it depends on who you're asking. This article would lend me to say that this guy doesn't have a very high view of whole life. And he says, and for a good reason. Statement, it is dramatically oversold. And then he gives this statistic from the Society of Actuaries talking about how many people give up their life insurance policies. But before we go there, I went to one of the life insurance space's most credible bureaus for looking at statistics of life insurance and life insurance holders. That's LIMRA. And of the American adult population, 51% owns life insurance. Is life insurance dramatically oversold if 51% of the people own it?
Yeah.
I wouldn't think so. And what if in that study, 42% of those people say that they need more life insurance? By the way, that's 102 million people. Would you say that whole life insurance is dramatically oversold?
No.
No, I'd say it's dramatically undersold based upon those statistics. And then what about the people who buy whole life insurance and surrender it? Well, how about the people who originate 30-year mortgages? Do they keep their mortgage for 30 years? What about the people who buy term insurance? What percent of those people keep their insurance policies through the term? Might there be good reasons to get rid of them? Oh, and by the way, if you give up your whole life insurance policy, are you losing everything? No, you're getting the cash surrender value back. There's lots of reasons why you might do that, but I do agree that whole life insurance is intended to be kept their whole life. I do agree with that, particularly when we're practicing the infinite banking concept. So that is correct. And Russ, just curious, inside of our life insurance practice, what is the persistency rate? What's the percentage of people who keep their whole life insurance policies with us?
So we have done over 1,000 families, helping them set up the infinite banking concept, and our persistency, which is the percentage of people who continue to not only hold on to their insurance policies, but continue to pay the premiums on them, is over 98%. Most of them over 99%. It is like, when I talk to the insurance companies, I ask them, how does that compare to others? And they say, yeah, our infinite banking clients, the people who are actually utilizing this tool, have the highest persistency, the highest rate of repaying loans, right? Like one of the biggest issues out there that is used, I don't know if it says in this article, I didn't read every piece of it because we're breaking down different portions for this podcast, but I've also read like, hey, when you take a loan against your insurance policy through infinite banking, you're increasing the likelihood of it lapsing, because they're using a different statistic that says when someone takes a loan against their life insurance policy, they're typically in financial turmoil, and then they're more likely to be in a scenario where they're going to, they may not be able to make the premiums. But for our clients, they're actually utilizing this as a tool to gain more control over their finances. They're not in a poor position, but in a good position.
Appreciate you adding that piece. I think part of this is he says, if you want to bank on yourself, I prefer the infinite banking concept. If you want to practice this concept, you're going to have to wade into this industry. I'll take an interpretation of that. You're going to have to understand what you're buying, who you're buying it from, what you're buying it for, how to use what you've got. And if you do wade into that, you might make better informed financial decisions. And just as we just mentioned, 98%, that's better than 80% giving up, right? 98% keep. In the mainstream of buying it, 80% give up. Well, maybe that's because the people that are helping actually do wade in. So I do agree with that statement. Let me share one more thing. And I know we've got a lot of other insight, a lot more article here. But this is a common thing. He says whole life insurance, the industry is plagued by overly expensive insurance. I assume he's talking about whole life insurance. And that's said out there. I don't think that it's actually true. So I went and did a little case study of my own and took a 30-year-old, called him Average Joe. Took an average Joe. He's 30. He wants life insurance. He goes and buys whole life insurance at age 30, keeps it until 76, which is average life expectancy right now in America. In order to have a life insurance policy that ends with $1 million of death benefit, you'd have to put a little over $5,000 a year in. So over that period, he'd put $236,000 of premium into the insurance policy to die with $1 million. $236,000 seems like an expensive number, right? But if the same average Joe went and bought term insurance every 10 years to have $1 million of death benefit when he died at age 76, he'd put $212,000 into that. So would you rather put $212,000 into term insurance and have to requalify for it each period of time? Or would you rather put $236,000 into whole life insurance, graduate with $1 million of death benefit? And is there any cash accessible inside of that insurance policy?
Yes.
What do we think the cash value of that insurance policy is going to be at age 76? Do you think it's going to be more than $236,000 that he put in?
Yes.
Yes, I think it's going to be north of $500,000. But, the life insurance industry is plagued by overly expensive insurance. I agree. Just not in the terms that he's speaking of. I think the term insurance potentially is the expensive piece of this if you knew that the infinite banking process requires you to buy a whole life insurance policy.
Well, Ernie, I want to add to that. Like, the most expensive insurance policy is the one that never paid out. Right? At the end of the day, term policies, he quotes this 80% rate of people that surrender their whole life policies prior to death.
Well, by the way, Joey, he's not, he comments, he does not, let's just for clarity purposes, whether this is to give him credit or take credit from him, he doesn't say whole life policies here. He says 80% of policies. Well, that it's hard to tell. Is he talking about whole life policies, universal life policies, index universal life policies, variable universal life policies, term policies? Which ones?
I do think he is talking about permanent life insurance because then in the sentence says these are policies designed to be held your entire life.
Yeah. Okay. Go ahead, Joyce. Sorry.
Well, the point I'll make is just a industry average of term policies is less than 2% of them ever pay a death benefit. So you are the judge of that. Like, which one cost you the most? The one that you spent 20 years, 10 years, 30 years, whatever the term policy is, paying in that never paid out a dime, or the one you kept for your entire life that you're able to use in this concept, in this process that is assured to pay out more than you ever put in, right? Like that to me is a simple math.
A little side note, this is more for humor purposes. I get that this guy must have a sense of humor. He wrote his article with sarcasm, and I love good sarcasm, right? It's my favorite. He mentions that when I've polled doctors that have actually purchased whole life insurance, 75% of them regret purchasing the policy. Now, I'm sure he could show you the statistic, like 3 out of 4 doctors that he actually has the details. All of those have told him they really regret it. So I just went into our own community yesterday, right? It was a small sample size of our over 8,000 people in our community. Asked the question, if you're using the infinite banking concept or you have done it in the past, would you say, A, I'm happy I did it, or B, I regret I did it? And our polling shows 100% of the people says I'm happy I did it. So now, I will say that 4 of our coaches who get paid to sell life insurance responded to that poll. So you can kick them out, but it's still 100% of the people not associated with receiving insurance commission said, I'm happy I did it. I do think it's important, too, to talk about, the importance of this in our life. So we didn't start out with this. I'm an owner of 30 whole life insurance policies. I've been doing this personally in my life, in my businesses, and with my kids, and with investment partners for over 15 years. Stallion, how about for you?
Absolutely. I have a lot as well.
Ern, are you practicing this concept, or is it something you just sell people who don't know what they're about to get?
Yeah, I'm an owner of 5 life insurance policies.
Jamie?
Also, an owner of 5, actually started as a client trying to figure out how this fit into my life, and have since joined the same. So yeah, absolutely a user of this, a big believer.
All right. So I think it's important that, that we practice what we preach. So this is not just something that we just get paid to do. It's actually something we love getting paid to do. This is not a nonprofit, nor is, by the way, the article and the site in which this guy runs, as you can tell by the number of ads I have to wade through on the way down the page here. So that's cool. Let's go into point number 2. I know this is going to be a long podcast. You have to break this up into different pieces if you're riding down the road, but hopefully this is worth it. Point number 2, he says, is the policy must be structured correctly. And he uses throughout the article lots of most, sometimes all, and I highlight those words because I just want to be cautious to not overly generalize things. So let's be careful not to say all or most or sometimes without specific statistics like 75%. We knew that he had that detail 100% correctly. He could have said most, but he gave us a very detailed statistic. Like I have 100% of people said they're glad they do it. Most commonly, policies are structured to maximize the commission that to the agent selling it. Would you guys agree? Like we maximize the commission for every insurance policy we sell?
That's a negative.
I highly disagree.
Oh man, he says he's cynical, but it's the truth. So either it's the truth or it's not the truth. I don't understand. It sounds like you guys are lying because I'm just going to say he's a doctor and doctors don't lie. You're right. And by the way, coming from a family of doctors, I have a feeling that they've never lied. And so I can tell you guys, this is true. 100% truth. You guys are lying. He also says the commission on a whole life policy is somewhere between 50 and 110% of the first year's premium. Is that true or false?
That's false.
Yeah. I mean, typically,
I don't know if I've ever gotten a commission of the low end of the first year premium ever for anything I've done.
Well, again, it's, I don't know if I can trust you because you get paid to do this.
Right. Yeah.
Fair. The point of an infinite banking policy is not the death benefit. I would say that's false as well. I don't know, but like a handful of the 1,000 people who've ever set up infinite banking through our companies that did not care about the death benefit. Like our typical person is a business owner, married with kids. They love their family. And there's nothing more than they would ever want to do than leave them the biggest pot of money possible, right? Whether that's through investments, and if they don't make it long enough for the investments to pay off to that point, it's through tens of millions of dollars in death benefit. Joey, when we first met and you were a client, how much death benefit did you have at that time?
$2 million.
$2 million. You thought you were dad of the year, right?
100%. Yeah. Like couldn't outspend me on the term policies that I had.
And you were making roughly how much money at that time?
About 300.
Equivalent to maybe an emergency room doc, right?
Sure.
And you're in a scenario where if you would have died with $2 million, how long would that have lasted your family?
I guess about 6 to 7 years.
Yeah. So during that 6 to 7 years, your wife better get busy either learning how to create a skill to replace your income or be out there connecting and finding her replacement for you. Otherwise, your kids are going to grow up at a house with no parents around them, right?
That's correct. Yes.
Sorry, I said that in an inappropriate way. Did not mean for it to come out the way it sounded. Especially if you're listening to this, Jessica, that's not what I meant by that. But the point is that most people, when they buy insurance, they think about it in case of minimums, not maximums, right? If we're not here, we don't want to figure out the minimum our family needs to live off of. We want them to have more, right? More than what they had if we were here, because we believe we could keep producing more. But if we're not here, then we know we can't. So we got to be able to give them the most. after setting up infinite banking, how has that number changed for you as far as death benefit?
Oh, it's more than 10x. But the point is immediately in just the first time that we set this up, not even all the many policies since then, it went from $2 million of term policies to over $3 million worth of whole life insurance that was going to increase every single year from that point forward. Yep. So immediately just implementing the concept, I started to have, 50% more death benefit immediately.
There was nothing worse than walking into class when you're in school and the teacher saying, "Pop quiz day." Why? Because you were unprepared. Are you unprepared, though, for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz.
I think it's important just to say this, is that the infinite banking community as a whole, and this is practitioners and clients, we have a love for our family, I think, that the world does not possess. And so it's okay. When the world says certain things, I don't think that they hold to the same standards we have. And so it's okay if other people don't have that. That's your standard. But I would say as a whole, our community just wants more for our family. And we're not looking to do less. Like, that is just not it. And I think, if we wrapped up this whole article, I think you could probably go on a line of a thought process that thinks one way versus another without even getting into all the details. But I know some of you guys like the math, and so I got to get into the math for you. So as we break this down, it starts to talk about the rate of return on every policy is important, very important. You want the ratio of premiums to death benefit to be as large as legally allowed, to be without becoming a modified endowment contract, which prevents the tax-free loans, and that's the whole point of the system. No, the whole point of the system is to literally have a place in which your cash can be stored so you can control the function of finance for you and your family. And whether that's, you're in our world where people love building streams of passive income, they want to take over that function of having more passive income, they have monthly expenses, or there are people who just want to take over the control of the banking function. They do not want to ever have their families, and when I say families, meaning generational families, if they could build it out, to ever have to go to a bank. Or you just want a safe place to store cash and you love the permanent death benefit. Everybody's a little bit different. But he wants to talk about, commissions and how much everything is. So I had to do a quick little review here. I went into, Google, and I said average cost of a mutual fund. This is what AI spit out to me. You argue with AI if you don't like it. The average cost of a mutual fund is around 2.81% per year. Okay, great. That includes his expense ratio and trading costs. It tells me that the average equity mutual fund, this doesn't include trading costs, is 0.44. Bond funds, 0.37. Actively traded funds, 0.59. Passive funds, 0.12. So I did a little case study over here. And this is for those watching on YouTube. You can see it. I took a $100,000 annual investment, right? We're talking about someone, he's talking to doctors. I'm assuming you're getting out, you're 30 years old and you got 30 to 35 years of savings. I'm going to use a 30-year time horizon. You got $100,000. You got to get busy, put some money away because you've been spending money for a good 15 years. $100,000 annual investment. If you were putting that at what our AI friend said in a mutual fund, just the cost alone, this put an investment return off to the side. Let's just focus on the cost. It would cost you over $1 million at that 2.81%. The average cost of an equity fund, no trading cost based upon this thing at the 0.44, it costs you $196,000. This is just the industry alone getting the money. Or if you're in a passive fund, it's $55,000. So none of this is free. The financial industry is not built on non-for-profits. So they're getting paid. But let's talk about compensation, because it's always about compensation. Insurance guys, all they care about is compensation. Well, a hedge fund manager, assuming you could invest $100,000 in a hedge fund, and you probably can't, but assume you could, we know they get 2% off the top line. That's $772,000, which would be their compensation off your $100,000 going in there for 30 years. If you went to just your run-of-the-mill registered investment advisor is charging you a 1% fee, $100,000 put into the fund. Again, I'm got zero return to this. So the higher the return, the higher the numbers. We get paid $423,000. Ernie and Jamie, you blood-sucking insurance guys, on that same $100,000 case would make somewhere around $108,000 over the same 30-year period of time. So $108,000 to you guys. Registered investment advisor gets $423,000 on the same amount of money. Hedge fund gets $772,000. You guys are in the wrong industry.
Sounds like it.
And all I'm saying is, if you're listening to the podcast, want to create financial freedom for yourself, just go become hedge fund manager.
When we're pointing out, and again, I have nothing against them. Great. Go be a registered investment advisor, be a hedge fund manager, be an emergency room doc, be whatever you want to be. Go make as much money as you possibly can, create as much value. And by the way, do you guys know life insurance agents in their whole year won't make $100,000 host out? They're just not creating enough value, right? Everybody gets paid exactly what they're worth. And you want to get paid more, you got to create more value. So I hate when people point out, oh, that's the only reason they're doing it. Now I can promise you, people can make money in every industry. That should not be the issue. All right, let's move down the deal here. Lots of things I could point out of misconceptions, direct recognitions. He says with a direct recognition loan, if you borrow out $50,000 of the dividend rate, if you borrow out $50,000, the dividend rate applied to the cash value each year only applies to the $150,000 that's left in the policy. Is that correct, Ernie? Ernie shaking his head.
That's a shake of the head.
That's a no. That's a no. They actually get a dividend on the whole amount, right? Now, if it was a direct recognition company, they would not get maybe the same dividend as the portion that hadn't been borrowed against, but they get a dividend. He says, well, why would they do that? If you were doing the non-direct recognition, the company still pays the same dividend, whether you borrowed the money out against the policy or not. Crazy, right? Why would they do that? Who knows? Well, I guess we know. That's, just like he's a doctor. He knows a lot of things about medicine that I would not even pretend to know.
And that's a clear indication he does not know. Sounds like he's asking for our help, actually.
Well, survey says we'll give him the answer, right? So why would they do that? Well, insurance companies have different levers that they use to build out their products. And if one of them is paying you a dividend on 100% of money, regardless if it's borrowed out or not, they have another way that they adjust things around. Maybe they adjust the interest rate. A lot of time you see variable interest rates, and that allows them, if they need to raise interest rates on loans to help offset any, operating expenses. For insurance companies who reduce your dividend, if you take a loan out, maybe, they can provide other things and other benefits to you that you don't see just because of that. He does mention that, hey, there may be something that you get in regards to that. Kudos to him for having thought of this. Also, I love the fact that he mentions here, while there are plenty of magicians in the insurance industry, there is no magic. Again, just because I have that sense of humor too. I love it. I did go post into the largest infinite banking community that I know. And I asked, hey, doing a little podcast research, are you a magician? Yes or no? 78 people saw it. Only 5 people commented, and they all mentioned some version of no. So I would say, if we're going to, nitpick you on things, we're not magicians. We're just not. I mean, there were a lot of things, but not magicians was one of them. All right. Point number 3.
Man, point number 3, you beat this one up a little bit already. I mean, I think I agree with it. I mean, do we stand to profit from talking about this concept? I mean, yes, we get paid for what we do, right? But to your point, do doctors get paid or stand to profit for recommending surgery, right? I mean, it's the same concept. Your what you make is in the value you provide to people. As we all mentioned earlier, we're believers, we're users of this concept ourselves. We've all seen how it's changed our financial future. I didn't join this team to come make as much money as I possibly could. While I enjoy making money, my goal was to help as many people as I could. I've said that multiple times. I know people listening don't know me personally, but that's my goal. I wanted to share the power of the infinite banking concept in my story with as many people as possible. I think, he also says in here that many insurance company or agents are selling policies that are not designed to be used for infinite banking, and maybe trying to present themselves as understanding infinite banking, or saying that you can use a standard whole life policy for infinite banking. I would agree with him there that you do need to be careful about who you set up a whole life insurance policy with. If you are listening to this and you go down the rabbit hole and get into the education and figure out that this is something that you want to do for yourself, it definitely is important to find and work with a coach, as already said, with somebody who fully and truly understands not only IBC, what the infinite banking concept is, but also how to apply that in your life, and also the mechanics of an insurance policy, how to structure these things right, how to apply the correct insurance policy to your goals, to what you tell them, and help you coach through implementing that into your world. And I think it's important to work with somebody who can articulate maybe why they did what they did, why they structured the policy, why they chose this insurance company for your situation. I think that's something that we all can do very, very well and very easily on our team. I would say, kind of just to nail this point home, like, is there a cost or is there a commission paid on an insurance policy? Absolutely. Right. But what is it worth to you, or what would it cost you to get 5-10 years down the road and realize that you had a policy set up and structured improperly, that actually wasn't set up in the best possible way to provide you with the ability to take control of the banking function of your life and accomplish those goals? I think there's a massive cost to that, right? And so I think working with somebody and allowing them to get paid, it doesn't come out of your pocket, right? It comes directly from the insurance company to coach you and to allow you to implement this into your world is totally worth it. My last point on this, and trying to keep it short, is he also says that the problem that those who know the concept best have a massive conflict of interest, and that we generally inflate the benefits of the concept, that we would have you believe that it was a secret magic pathway to wealth, when in all reality, all it does is help you earn a little bit more cash, or a little bit more on your cash in the long run. Artie, is that all it does? And do you tell people it's a secret magical pill?
Actually, I think you probably got that from me. Yeah, that's what I do.
I think we all pretty clearly articulate this is not a secret magical pill, right? This is not a get rich quick scheme. You can't just put your money in here and like all of a sudden, boom, you're going to be, richer than you were yesterday. I will over time, right? But it's not going to be a magical pill. I know I'll be the first to tell you it's not a magical pathway to wealth. In fact, again, that's why we specifically coach our clients on how to incorporate this. How do we take this specially structured whole life policy and help you build a cash flow system, right? Also known as the PIAS, how we incorporate the passive income operating system into your life, right? How you get the most out of the tool, which is the whole life policy. You implement it with IBC, the infinite banking concept, and then you incorporate the PIAS, the passive income operating system, to flow your cash through the system, right? And so I think it's important to kind of differentiate those things. And I know that I don't sell this as a secret magical pill. In fact, I tell people almost every day that it's not a magic pill, and that, we need to actually figure out how to use this in your life.
It's because you guys aren't magicians, man.
That's right.
He's interviewed and talked to enough magicians that are in the space that's where he comes from. I get it. Like, the people that we asked were not magicians, so they probably wouldn't say that. But the people that he's talked to probably would. I get it. It makes sense. All right. Let's move on a little here. He says, number 4, it allows you to earn more on your cash in the long run. So that was the point, and he was wanting to kind of determine underneath it, does that really meet? He says the real benefit of the infinite banking concept is that you'll probably earn a little more on your cash over the course of your life than you would in a bank account at the cost of a few years of crummy returns on your money. Seriously, that's it. He goes on to say a little lower, you should compare borrowing against your policy to withdrawing money from a savings account. Okay, I'll do it. If you ask me to, you ask and I'll deliver. That's just what I'm here for. So I used a little tool called True Concepts. It allows you to put some numbers in it. And I just went back to that $100,000 example. I use the 2% savings rate. I mean, I don't think I'm actually getting any interest on my savings. But some people are, right? I don't know what it'll be over the next 30 years. If it's like the last 30 years, it'd probably be negative. But anyway, I just gave 2% earnings. Obviously, unfortunately, the government does want some of the money, unrealized or not. So I just put 25% as the tax rate on there. And so $100,000. And then he talks about you can go buy a boat, or you can buy an RV or a car or whatever. Now, I said boat because Ernie, you and me like boats, right? And so I went in here to
do that. I'll tell you, you can go borrow from life insurance and buy a boat.
You can do that, or you can take from your savings account. So this is an example of a person putting in $100,000 into their savings account every single year for 30 years. And we know that they're not going to just let the money sit here. Don't come back with those comments. We literally have to isolate one scenario so that we can compare it to another scenario. If it works for one, it's going to only get better for other ones. If it doesn't work for one, it's not going to get any better, right? So we can use logic to help us discern this. So in year 2, for those just listening, they went to their savings account and they took a withdrawal, meaning they paid zero back, right? You guys see that? $100,000 coming out in year 2. Account value went down, right? And then they just keep earning interest on that money and the $100,000 they keep putting in there. And so I highlighted at the end of 30 years, my calculator, it was not long enough for you to see the next 7 years, but just believe me, I'm not a magician. I'm not making up stuff here. That it's $3.6 million in the account at the end of 30 years. Or he said we should borrow against the life insurance policy and compare. So I went in here. I did an example. I put $100,000 in a life insurance policy. In the first 3 years, the cash value is less than what you put in it, right? So that's all what he talked about. That's true. Put the $100,000 in, and then in year 2, I took a $100,000 loan out. I borrowed from the insurance company, the $100,000. Now, to keep apples to apples, I didn't pay it back. Put zero repayment, right? And he talked about loan interest rates. It could be as high as 8%. I have 30 insurance policies, and I do have one policy that has an 8% loan rate. The other 29 do not. They're significantly lower. But, I just want to use his number, so I put 8% as my loan rate. He said you would just have a little bit more money, potentially. So, I don't know what numbers you're using. The smaller the numbers, the smaller the amount of money, but I'm sure it's big to you if you get smaller numbers. Put $100,000 in for 30 years, take $100,000 out as a policy loan. I got $4.9 million. $4.9 million compared to 3.6. Joey, little or a lot?
I'm going to go with a lot here, Russ.
It all depends, right? It all depends. All right, let's fast forward down here, Jamie. Talk to me a little bit about Section 6.
Going back to magic, right? You just point out that this is not magic. I agree that it's not magic, right? And so he talks here that those are the only benefits, kind of everything we've run through already, that's the only benefits. Everything else is a hyper scam. I just hate it when you say everything, always, things like that. And again, saying that it's a scam. I know there may be people out here that are inflating what IBC is, or bank on yourself, or all the different names people are using. I know for a fact there's people trying to say that you can do the infinite bank concept with the wrong insurance policies, so there's some good in this article and there's some bad. And I think one of the goods is it's not magic. However, what he goes to say is that you can actually retard your wealth building if it keeps you from investing in things like a 401k or a Roth IRA. Like if you're skipping on those to fund this policy, you're going to surely come out behind. Well, I can firsthand tell you that is false, 100% false. In fact, I think a lot of people's 401ks got significantly retarded here in the last few months, right? So I don't know where he's coming up with that. For me, in my world, and he goes out to point this out a little bit later, I'll get to it, but I wanted more real estate, right? I saw the power of building wealth with real estate, building cash flow today. And so I wanted more access to my capital to go do those things. I wanted to control, as Russ said earlier, the financial function of my family's life, right? The financial future and function of my family's life. And so for him to say that there's no other benefits to me, tax invisibility, and what I mean is having tax-free loans, but also tax-free transfer of wealth with a death benefit, access to my cash today and not when I'm 65 and a half, for me, what is that? 30 years from now, 25 years from now. God, I'm getting old, guys. True uninterrupted compound interest. He tries to say in this that when you take a loan, the money does not compound the same. I'll come back to that. But creditor protection is a huge one that works for me. Again, being in real estate, I like the fact that I have some creditor protection and death benefit. That all sounds pretty good to me. I mean, if there's no more benefits to that, then I'm pretty okay with that. Back to the skip into the 401k, he does talk about real estate investing and using these to buy real estate. He says that this is not a replacement for something like 401k. It's just where you save to buy real estate. I mean, exactly. Yes, that's exactly true. That's exactly how I use it. This is where I put money to save to go buy more real estate. And you know what? I want more real estate. And when I buy more real estate, I want more cash flow. And when I get more cash flow, I get more time. And when I get more time, I spend more of that with my kids as they're growing up very quickly. And kind of back to the point of, he says, money borrowed earns nothing and is interrupted in the same way. And that people will try and tell you that you're doing two things with $1 and it's not really working like that. Well, I believe it is. I'm one of the people that talks about velocity of money because I understand velocity of money. I understand that if I can use leverage in my life, that I can get more assets that produce more cash flow. And so, yes, I use infinite banking policies or whole life policies and the infinite banking concept to store my cash, to go use to buy real estate, right, as a down payment or whatever that may be. Meanwhile, my cash is growing within my whole life policy all of the time. To me, that's called true uninterrupted compound interest. And then, yes, I have a loan that I have to pay back through the cash flow of my dollars. But what's happening is my money's still growing while I'm using it, versus the example you just gave, Russ, of pulling it out of a system and giving up the opportunity cost to ever grow with that money again, or ever have that money grow again. So is it magic? Absolutely not. There's some good points in here, but also I think there's some bad points in here. And I think it's just understanding and truly understanding how this all works together is super important.
Yeah. Ultimately, Joey, it's not revolutionary, it says.
Well, there's several points in here. I'm not going to belabor this one because I feel like it was more his opinion versus any sort of actual factual data of any sort. But he does talk about how this is positioned in a way that gets you out of the banking system. And he says that the insurance companies are actually part of this same financial system. I don't disagree with the fact that the insurance companies are a part of the financial system, but the part that he fails to see is that banking is constant in your life, whether you are the one that's taking kind of control of that function or allowing it to be done by somebody else. And the banking function in the traditional bank is creating inflation because they're printing money. They have the ability to use fractional reserve banking. We can dive into that another time. Whereas an insurance company, when you have your capital on reserve with them, they have to maintain maximum amounts of reserves. In fact, I did a quick search, and insurance companies keep anywhere from 60 to 90% of total premiums collected annually in some sort of policy reserves, contingency reserves, asset valuation reserves, or interest maintenance reserves. That's a lot of reserves.
How does that compare to how much money a bank keeps on reserve for every dollar they lend out?
Well, use the fractional reserve maximums, and it's like 10%, right? They can loan out 10 to every $1 that they have on deposit, which immediately creates instability in the ability that bank could be shut down at any time based on anything goes wrong with the market. And we've seen those numerous times. And that's why these mutual life insurance companies are far superior in terms of security, because they've been around for over 100 years, and it's because they have these sort of business practices that give them that stability. The other thing that I'll just point out here is he talks about how your investments should be boring, like your life insurance. I think that's just the fact of you need to know your investor DNA. We talk about it all the time. Once you know your investor DNA, your investments are no longer boring, by the way. They're super exciting because they line up with who you are, and you can start to see the benefit of what you're investing in. And then
that's one person whose investor DNA probably loves boring investments.
Yeah,
and assumes
exactly.
that everybody else is exactly like them. And we're smart enough to know that the world is not like us. And that's where the investment DNA came from. Jamie, do you like your investments boring?
No, usually if they're boring, I forget about them.
Ernie, on the other hand, do you kind of like a boring investment a little bit?
Yeah, I do kind of like that. I'm into that. It's attractive to me.
Yeah, it's your profile. I mean, this is just an example of how the world tries to put everything in a box. Everybody fits in this one box. All the insurance policies should be designed this one way. Nope. Everybody thinks about life this way. Nope. Everybody goes to the doctor and takes 100% of their advice. Nope. I mean, there's literally not everybody is not the same. You can't treat a patient exactly the same as everybody else because otherwise they won't all take your advice. You have to prescribe medications, financial advice, or understand what you're doing with money based upon your unique scenario.
Right. And just a couple quick points and I'll finish out here. For him to say that if it is making you excited and you feel a need to go proselyte it to your friends and family, you are likely mistakenly buying into the scammier aspects of the concept. We'll call Jamie and I the biggest scam artists of all sorts because we literally left our careers to teach people this concept because of the immense difference it made in our own lives. That's obviously somebody that doesn't understand the concept that would make a comment like that, number one. And I'll say this to close this out. He mentions that these also come with asset protection you probably don't need. Like, that is just an asinine comment. Like, asset protection, if you had it versus not, you would always choose to have it. Like, it just makes no sense why you would say something like that. But the last thing I'll say is he leads off and says it's not revolutionary. Well, as you just showed, Russ, just a very simple analysis of putting cash into a place that didn't cost you any more to put it there and having a $1.3 million difference over the 30 years or however long that was that you showed. Imagine that all of the cash that you're going to invest was on the same sort of growth track that he just showed. I would tell you this, the only reason why it's not revolutionary to this author is because he doesn't have his cash doing two jobs at once. And you can say that that's a scammy way to say something, but literally the math shows you that your money is growing and the assets that your money buys are growing, assuming that you're investing properly, right? So I think it's absolutely revolutionary enough to where for generations from now, they will be talking about what we did today to put them in the same position that they will be in. And that's a reason why I was willing to leave my career to do this. So that's my thoughts on that.
And the example I shared, I didn't say this, but we know that whatever one of them invested in, the other one could have invested in at the same exact time. And whatever return those things would have produced, they would have produced equally if they invested in the same thing. So the numbers are the numbers. So whatever that investment is, it's running off to the side and it is as much as it wants it to be, right? Both of them could invest in the same exact thing, savings account or the insurance guy, right? Or go. So the math is the math. And ultimately, the more money we make over here, what does that do? It makes more inputs over on these other columns. So if it was 1.3 for $100,000, what do you think it's for 200,000, for 500,000, for $1 million a year? I mean, we have clients who are putting over $1 million a year into these systems. They must be morons, right? Because that's how they got to the ability to be able to put $1 million in, is that they make dumb mistakes with money. And people do make dumb mistakes with money. Unfortunately, they do. They don't consider the information and how it applies to themselves. So if you want to financially educate yourself, you have two options. You can go to what'swallstreet.com/free call, or you can go to White Coat Investor and take his course. He'll sell it to you. It looks like anywhere from $99 up to $13.99. There are options for you no matter what, and there's everything in between. Coaches, thank you so much. Thank you for listening. Have an amazing day.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.